Hello everybody. Alright, today we're going to look at Cisco. A while back, let me just go on badcharts.com. A while back I did a analysis on Cisco. Wow, February 2015, so that takes me back almost 3 years. And back then we had a huge 7-year base and it was breaking out, so we could go to our chart and see how that actually panned out. Well, and that one, okay. So here I have Cisco, February 2013. How did I have my lines back then? Like this, maybe. Something like that. Maybe here, shorter term pattern. And these Cisco seems to have had some nice sideways action. And we had a breakout to the north. Copy that. We had a breakout with this candle right here. And what happened here? All right. So now that's how I had seen it back then. Let's move my margin a little bit. And let's back up in time. Okay. Right here I had identified my multi-year base. I had identified a bullish move. Conservatively, I could have had a target with this shorter term formation, which is still 1, 2, 3, 4, over a year, which would have given target of 30. Or we had the larger base, multi-year base, 7-year base, which had a target of 35.5. And that's what happened here. You would have you would have bought here 27.67, put your sell stop at 24.45 or underneath this candle. And your exit stop at 35.80, your profit stop, if you would have played the larger pattern. If you would have wanted to play the shorter term pattern, the target would have been 30. But the risk reward, here's your risk, 1. And your reward would have been not even 1. So it wouldn't have been a super good risk reward ratio. Not an A++ setup. It has to have a good risk reward ratio for it to be an A++ setup. You would have probably either got greedy, played the longer term pattern, or moved on to another chart where this pattern, where you had a shorter candle on the breakout line, giving you a better risk to reward. All right, let's move in time. One candle up. Oh, good. Oh, 3-4 months later. Oh, starting to go down. Not quite. Oh, here, you see, on the third month, if you would have taken the shorter term target, you would have reached it here. Maybe this candle, 30, and your target. Smaller risk to reward ratio, but shorter target also. Less resistance on the way. Higher the probability of reaching that target. So it's a trade-off. If you have a high success ratio of your trades, let's say you're right at three times out of 4, then you could probably play these 1-to-1 ratios. You'll still be okay if you lose that 1 time out of 4. If your success ratio on your trades hitting your target is only 1 out of 2, then you want at least a ratio of 1 to 3. So even if you lose half of the time, you still make 3. You still make net. All right. It's all about risk to reward and how many times you're able to attain that target. That mix is part of your risk management, which will tell you if you're going to be net positive based on that sound logic, or if let's say you want to play 1-to-1 ratios, risk 1 reward 1, but your success ratio is just 1 out of 2, then you'll just be, overall, you'll be losing commissions, time, effort, right? Because you win 1, then you lose 1, and they just, it brings you down back to 0. You don't want that. You want to skew the odds in your favor, and always try to have risk to reward sufficient in the matters that your percentage of times you hit your targets is makes it you a net gain. All right, hope that made a little sense, and let's move on to see if that larger target was reached. And 1, 2, 3. Oh, and here, no. All right, let's back out. Right here, this candle went all the way under your sell stop. You would have been triggered out here. You would have lost your 1%, and you would have said, okay, misread the chart, whatever reason, and I just didn't get to it, and that's it. You take your 1% loss, you go home, and you, in the meanwhile, you've been looking at other charts, other A++ setups, and that's it. So it's pretty good to have that there. If you wouldn't have had a sell stop, you would have been stuck here at 23. What do I do? Do I double down? Do I get out here at 23? Now you're already like 1.5% loss of your NAV or more. Now you don't have to think about all that. It's been taken care for you by those bracket orders you attached to your purchase order when you got in. And what happened to there you go. You got triggered out. Time moves on. And here there's some resistance being established. And the chart's morphing. And maybe here we have, see now there's a new rectangle here, new range being created. And that's the one you could replay if you wanted to get back in. Live to find another day and just look for another pattern if you want to re-enter. Don't get attached to the stock. Don't say, oh man, I have a feeling this is how there's a pattern in the stock. No, it has nothing to do with the stock. It has everything to do with the chart and the price action and what the people buying or selling are actually doing. All the rest, noise, whatever, which way you want to phrase it, it's just noise at the end of the day. And it's on the price action you make money. It's not on the news. It's not on the hope. It's on the actual day or minute price of the stock. That's all it is. That's all it's about. So right now, this pattern, another pattern you could that it morphed into, and okay, it's okay. I got triggered out here, but now I have another 1 year and a half pattern, breakout candle. You could enter here at 30.53, put your sell stop here at the bottom of the candle at 28, and your target's all the way here at 34, almost 35. Risk to reward seems pretty good. You only risk 1. This is your 1. There, so it's a 1.5. Risk 1 to win 1.5. If you reach your target 50% of the time, you're okay with that. And what happened here? 1 month, 2 months, 3 months. Oh, trending down, going back up, and down, up. You're still not triggered out, right? Your sell stop is all the way down here. And the stock, and there we go. Bang, 1 year, 6 months, a year, almost a year later, you got your money and you're out of that trade. And what happens? Well, another pattern, another launching pattern for the next move has also been in the works and has coincided with you reaching that target. Will you play that one? Well, you'll have to see. Put my target here. Let's move along. Oh, wow. So that one resolved really fast. 1, 2, a year and a half. Breakout candle. Put your sell stop under. Purchase order here. Not a very good risk to reward. I would have probably not entered that. But the continuation move, target reached really fast. Lower risk to reward ratios, but usually higher probability of reaching that target. And that's it. 1, 2. 2 months later, you got it. And is that where we are today? Yeah, that brings us to July 2018. Yeah, that brings us to today. So that's where we are for Cisco. We have to wait. Target reached. Absolutely on the monthly. Absolutely no pattern. I don't see any pattern yet. Maybe this will be some support sometime. Don't know. Time will tell. It's not a top, because for this to be a top, you need a red candle below it. So if I would want to compare with the RSI, right now there's no divergence. Higher high, higher high. Nothing to see here. Just need to wait. You could always get curious and drill down on the shorter time frames and see if the shorter time frames are starting to sing a new song. Give you some clues on maybe how the monthly candle chart will maybe change or morph into. But even here on the weekly, you see there's still no pattern. It's still we have to wait for more candles. Let's go drill down on the daily if there's been some consolidation and maybe a sideways pattern to give us a launching pad. And what do I see here? I don't see anything here right now. No launching except that other signal that we had here. And you see on the monthly, the weekly, and even the daily, they all had that breakout here at that point. Or maybe I'm wrong. Where did I put my arrows? Okay, so go back on the 10-year monthly. No, that's a breakaway candle. You would have gotten out. Yeah, there. Gotten in. And that's the story for Cisco. Still in the bullish uptrend. There's a launching patterns maybe that are happening regularly. Keep an eye out for that. Those consolidation patterns, remember that it's an uptrend, but you always have two possible targets moves, right? You have either it could consolidate and go up, or it could consolidate and go down. Keep an eye on, see if just before pulling the trigger, if you have a divergence with your RSI, to validate that A++ setup, or give you maybe some clues that it's on A++ setup. All right, let's go back to my blog I did back then. And sometimes I've noticed I go back and the lines aren't drawn exactly how it was before, different levels. So it's kind of scary, but at the same time, you have to accept it that I'm not a robot. And I will draw lines on different levels. That's why, in case of doubt, always choose the closest target. You could always reassess on another launching pattern or another chart, if ever the case need be. Don't get greedy. You might have misread. Put the support a little too high because you wanted to make your risk to reward fit. You wanted to have better profits. You could have cheated on the support, on the resistance. Look, if you're human, your subconscious is always going to try to influence you to do stuff. So in case of doubt, choose the closest target, and that's right. And that's it. Back then, I had my launching patterns on the daily, on the weekly, and I never got back to it. So right now I did a few years later, and that's where Cisco at. It did reach that target. What's the eventual target I had? Target 41.50. That was my eventual target. But remember, I got triggered out, and I had to get back in many months later to be able to play it right out to that actual final target. So there's a price, and there's also timing. Two important things that you try to think of. But what protects you ultimately, if you're wrong, is your sell stops and your money management. Thank you very much, guys, and with no further ado, see you.